They say you can't just print money forever, but what if I told you we already are? And the people running the machine just admitted it on live television. I'm Nate Ledger, and I've spent years decoding the quiet confessions buried inside fiscal policy, inflation reports, and Treasury speeches no one watches twice. But something changed this week. The Fed and the Treasury, two institutions meant to keep each other in check, just got remarried. And their honeymoon, it's paid for in your dollars and possibly your future. I'll explain exactly how and why Bitcoin might be the only way out in just a moment. The Fed was never meant to be your ally. Most people don't realize this, but the Federal Reserve, the so-called guardian of our currency, isn't even a government agency. I remember the first time I found that out, I thought it had to be a conspiracy theory. It's not. The Fed was created in 1913 by the Federal Reserve Act passed just before Christmas break. While most lawmakers were home for the holidays, it was designed as a private central bank with public oversight. In theory, it manages interest rates, controls inflation, and remains independent of politics. But that independence? It's always been more illusion than reality. During World War I, the Fed quietly began financing U.S. debt. By 1917, it had purchased $2.5 billion in government bonds, half of America's entire wartime borrowing. The pattern returned during World War II when the Fed was forced to cap Treasury yields to keep debt service low. Sound familiar? And here's where it gets interesting. In 1951, a dramatic standoff, now called the Treasury-Fed Accord, restored the Fed's independence. But behind the scenes, that handshake deal only lasted until the next crisis. Every recession, every war, every emergency since, the Fed gets pulled back in, like a reluctant partner in a toxic relationship. Fast forward to now. Treasury Secretary Scott Bessent just called the Fed's PhDs unqualified and said he's heading into their building to personally evaluate their work. Meanwhile, Kevin Warsh, a former Fed governor and now top candidate to chair it, told CNBC, "We need regime change at the Fed. The models are broken. Inflation isn't about wages, it's about printing too much, spending too much, and living too well." That wasn't a slip, that was a shot across the bow. And the fact that it aired on mainstream television, that tells you everything. The merger between the Fed and Treasury isn't coming. It's happening. And once they're under one roof again, who's left to stop the printer? But here's the real twist, and I'll walk you through it in the next chapter. They're not printing for you. They're printing for something else. And that something is absorbing trillions of dollars without touching inflation, yet fiscal dominance, when debt becomes the master. I used to think the Fed controlled the game. Interest rates, inflation targets, balance sheet normalization, they made it sound clinical like a lab. But what we're in now isn't monetary policy. It's fiscal dominance. Here's what that means. When a government borrows so much money that the central bank must keep interest rates low just to keep the country solvent. And right now, the United States is paying over $1 trillion per year in interest alone, more than it spends on defense. In the 1990s, interest on federal debt was just 14% of tax revenue. Today, it's pushing 35% and climbing fast. So when Warsh and Bessent suggest the Fed should coordinate closely with the Treasury, what they're really saying is, we need cheap debt or we default. And to get cheap debt, they need stablecoins, digital dollars backed by US treasuries. The Genius Act, just signed into law, legalizes that flow. It allows private companies to issue stablecoins, pegged to the dollar, but backed by short-term treasury bills. It's a clever way to fund government spending, without selling bonds to China or raising your taxes. The Fed used to sell treasuries to investors. Now they'll pump liquidity into private stablecoin markets, which quietly buy the same debt, just through a different door. But here's the kicker. Stablecoins only scale if the demand for them grows. And the fastest way to do that? Make Bitcoin rise. That's not speculation. That's the feedback loop no one dares talk about. Until now. The Genius Act, Trojan horse, or monetary breakthrough. When I first read the Genius Act, I thought it was just another regulatory bill. You know the type. Long, boring, full of technical language. But buried in its 97 pages is something that changed everything for me. It creates a legal pipeline from the US Treasury straight into crypto. Officially, it's a bill to regulate stablecoins, those one-to-one dollar peg tokens backed by T-bills. But the act does something much bigger. It turns private stablecoin issuers into liquidity providers for US government debt. That's right. Circle, Tether, whoever qualifies, can now buy treasury bills en masse and issue digital dollars in return. What does that mean in practice? It means the US just created a backdoor funding mechanism for its $34 trillion national debt. Foreign countries may be dumping treasuries. China's holdings, for instance, have dropped from $1.3 trillion in 2013 to under $800 billion today. But stablecoin demand? That's growing fast, especially in Latin America, Turkey, and sub-Saharan Africa. I remember watching Scott Bessent announce it. He said, stablecoins will expand dollar access across the world and create new demand for treasury debt. He didn't flinch. That's when it hit me. This isn't about decentralization, it's about rerouting trust. Trust away from foreign buyers and into programmable liquidity rails. But here's the part they won't admit. Stablecoin supply can't grow unless something else grows alongside it. That something is Bitcoin. And the deeper I looked, the more it made sense. Let's break it down in Chapter 4. The real reason. They're growing Bitcoin. When I first saw the chart, I had to double-check the data. It showed Tether's market cap rising almost lockstep with Bitcoin's price over the last 5 years, from under $1 billion in 2017 to over $110 billion today. Tether didn't just follow Bitcoin, it amplified it. That's when the light bulb went off. Stablecoins grow because Bitcoin grows. It's not philosophical, it's mechanical. On nearly every major exchange, USDT is the default trading pair for Bitcoin. When Bitcoin surges, liquidity surges. Traders buy Tether to get Bitcoin. Institutions use stablecoins as a ramp. The math is simple. If Bitcoin 10x's, Tether's market cap must expand to meet that demand. I remember watching Bessent hint at it without saying it directly. He praised the Genius Act, then said stablecoins would grow into a $3.7 trillion market. At today's ratio, that implies Bitcoin north of $37 trillion in market cap, over $1 million per coin. But why would the US want that? Because it's the cleanest way to absorb inflation without it hitting groceries or gas. You don't want the dollar to collapse against eggs, that causes riots. But against Bitcoin, against an asset only 2% of Americans own, that's manageable, palatable, quiet. I've said this before, but I'll say it again. Bitcoin doesn't need them. They need Bitcoin. And they're betting you won't notice until it's too late. Let's follow the trail back in time. To the last time the Fed and Treasury teamed up. What happened next changed everything. Remarriage of the Fed and Treasury, a dangerous reunion. The phrase that stopped me cold came straight from CNBC's Chiron. Fed Treasury regime change. Not a rumor, not a blog post, a mainstream financial outlet flashing it in bold. That's not forecasting, that's notification. And I couldn't help but remember the last time they were this close. Back in 1942, the US was deep in World War II and bleeding cash. To finance it, the Federal Reserve agreed to peg Treasury yields at 2.5%, effectively ceding control to the Treasury. Over the next decade, the Fed's balance sheet grew over 10 times, loaded with war bonds. That marriage lasted until the 1951 Accord, when they divorced to restore Fed independence. But here we are again, 2025, and it's happening all over, this time without the bombs, just debt. Today, U.S. debt is $34.8 trillion, with interest payments alone topping $1.2 trillion annually, more than Medicare or defense. The government can't afford for rates to stay high. So, it's doing what every over-leveraged empire does near the end. It prints, then it lies, then it partners with its own central bank. Kevin Warsh says the Fed needs to stop using broken models and start working with the Treasury to reflect reality. Translation: the Fed won't fight inflation, it'll fund it, and just like in 1942, that means the Fed's balance sheet is about to explode again. But this time, the wedding gift isn't bonds, it's Bitcoin. And the honeymoon is inflation you won't see coming until it's already in your wallet. The new theory of inflation. For decades, economists clung to the same playbook. Inflation rises when workers get paid too much too fast. It's called the Phillips curve, and it's been baked into Fed models since the 1970s. But there's one problem. It no longer works. I remember Warsh's voice as he leaned in on CNBC. Inflation happens when the government prints too much, spends too much, and lives too well. He wasn't theorizing, he was testifying. And for the first time in 45 years, someone near the top said out loud what the rest of us already felt. Let's put it in numbers. Between 2020 and 2022, the US printed over $6.3 trillion, expanding the M2 money supply by more than 40%, the fastest jump in modern history. Meanwhile, real wages stagnated, yet housing, food, and fuel exploded in cost. That's not wage push inflation. That's policy-driven inflation. In 2021, inflation hit 9.1%, the highest since 1981. And how did the Fed respond? With transitory sound bites and late ineffective hikes. That's when I stopped believing this was incompetence. It started looking like design. Why? Because inflation, when used strategically, shrinks debt. If you owe $34 trillion, debasing the currency by even 5% saves billions annually. But you can't let the public notice, so you channel it into non-consumption assets. You inflate Bitcoin, not bacon. That's the sleight of hand. And in the next chapter, I'll show you how they're doing it right now, under your feet, with your retirement. Bitcoin, gold, and the safe exit ramp. I used to think inflation was just a bug, a side effect of war, greed, or incompetence. But it's not. It's a feature, a pressure valve built into the system. The trick is directing it somewhere you can afford to lose. I remember reading a 2022 internal IMF memo that hinted at it. Non-consumptive stores of value offer a deflationary shield for politically sensitive goods. Debase the dollar against assets people don't eat or live in. You can't inflate against eggs. Try raising egg prices by 60%. You get riots. But inflate against Bitcoin or gold. Most people don't even notice now, or they cheer it on. Here's where it gets surgical. In 2024, Trump greenlit a plan to allow $9 trillion in U.S. retirement accounts to be invested in Bitcoin, gold, and private equity. No headlines, just a quiet executive order. The same week, his media company bought $2 billion in Bitcoin. I remember thinking, this isn't about tech or liberty. This is a liquidity trap. They're positioning Bitcoin as the sink, the catch basin, the monetary sponge that absorbs all the new dollars without flooding housing or food. Because if Bitcoin 5x's, so does stablecoin supply. And that means more treasury demand, without needing China or the Fed or taxes. It's a masterstroke of silent economic engineering. But it raises one final question. If retirement funds are being redirected, what happens to stocks, bonds, and the entire legacy financial system that's next? The final loop: retirement funds, crypto, and the Fed's last trick. The last time I checked, 401k plans held $7.3 trillion, nearly a third of all U.S. household financial wealth. For decades, that money sat safely in index funds and bonds, managed by sleepy custodians and Vanguard algorithms. But something changed in 2024, and almost no one noticed. Buried in Section 407 of Trump's deregulation package was a single line authorizing alternative assets for retirement accounts. That meant crypto, gold, even private equity. For the first time in U.S. history, Main Street's retirement could be funneled into monetary instruments that don't support the dollar, but replace it. And the timing wasn't random. In the first quarter of 2025, the Fed began shedding long-term bonds from its balance sheet, while stablecoin issuers quietly absorbed over $140 billion T-bills, much of it financed through retirement-linked liquidity pools. I recall a JP Morgan analyst whispering on Bloomberg, "We're seeing a quiet rotation from public markets into hard collateralized instruments. This isn't rebalancing, it's regime shift." Why? Because stocks no longer offer the safety valve, they're too volatile. Bonds? Useless when rates are rigged. So the system needs a new sponge. And you, your pension, your IRA, your 401k, are the funding source. They're turning retirement into the final buyer of last resort. You won't notice until your index fund sells off. And your crypto exposure mysteriously spikes. I've said it before. This isn't a crisis. It's an extraction. Quiet, systematic, almost beautiful, and it's already done. They're using your retirement to fund the next monetary regime without telling you. If that sentence made your heart skip, you're exactly who this channel was made for. Stay sharp.